stressed home borrowers heading for a mortgage cliff.
A sharp rise in their monthly repayments.
Mortgage holders are bracing for a big financial hit.
The fixed rate cliff and how to avoid it. So in this video, we're going to help you understand why interest rates have moved, how to potentially negotiate a better interest rate at the end of your fixed rate, and how to avoid getting caught out. If you're currently looking for a home loan or you've got an existing one, this is a video not to miss. Fixed rates have been hugely popular over the last few years, but what is the benefit? With a fixed rate, they're set over a period. In Australia, typically we see fixed rates for 1 to 5 years. So during that period, it makes it really easy to budget. The fixed rate does not change, it stays the same compared to a variable rate, which can go up and down depending on the market. And during COVID, it made a lot of sense to get fixed rates. There were fixed rates at the time at 1.99% and below. And as a result, almost 40% of home borrowers were looking at fixed rates. As you can see, proportionally, it was massive compared to historically, it was much lower. Now, the concern in the market is with all these fixed rates ending in 2023, it's 2 years beyond the pandemic, when these people are fixing, there's a lot of people that are going from 1.99% to 5.5%. And as a result, repayments are doubling and tripling what they were. Now, add to this, we've seen the banks giving bigger discounts. So you could have your fixed rate coming off and you could be receiving a discount that isn't as good as it is today. Let me explain. Banks can be like mobile phone providers. They'll give new customers the new and shiny best rates of the market and kind of forget about the existing ones. So as a result, if you took out a home loan a few years ago, you're probably not receiving as good a discount. Let me show you an actual example. TikTok, an online provider, actually show their interest rates from the last few years. And as you can see here from the screen, if you took out a home loan in May 2020, your interest rate today would be 5.79%, compared to the brand new customers that are coming off the street are getting 4.79%. So they're actually getting a 1% less discount because you took out a home loan almost 3 years ago. This is where it becomes important to be proactive with your home loan provider, and if your fixed rate's coming off, you want to take some of the steps we're going to go through in this video. But before we do, what actually happens when your fixed rate ends? When your fixed rate ends, it will revert back to the bank's variable rate at that time. If you had a fixed rate ending during COVID, your variable rate would have been pretty low, but over the last few months, Reserve Bank has progressively increased interest rates to a point where the standard variable rates are much higher than they were a few years ago. This is where things get a little bit tricky depending on your bank. Some banks will preload a discount when it goes back to a variable rate. If you took a home loan out a few years ago, they'll say when your fixed rate ends, you will get by default a 2% discount off our standard variable rate. It just means your interest rate, while it's going to go up a lot, is not going to be as bad if it gets a 0 discount. Other banks like Westpac and St. George won't give you as good a preloaded discount. And this is where some banks hope you're not really paying attention. They're just hoping you don't notice it goes back to variable and you've got a 1% less discount than the new customers on the street. What can you do to actually avoid this from happening to you? In the months coming up to your fixed rate ending, have a chat to your broker or your lender and find out what the revert rate is going to be. In other words, what your interest rate is going to go back to when it becomes variable in the next few months. Now ask your broker to compare that to the market. How does it compare? How does it look? And in some cases, you can actually reach out to your lender and say, hey, Westpac, hey, St. George, I don't like that discount. You're only giving me a 1.7% discount. I know at the moment you're offering a 2.7% discount across the market. Even their own website openly advertises a 2.19% discount. So if you're an existing customer, you definitely want to be hitting them up. Short of this, you can look at other lenders who are offering cashbacks to help provide incentives to cover the cost of refinancing. Generally, that's about $1,000. But fortunately, you do have some options when it comes to the end of your fixed rate period. As I mentioned earlier, the default is it'll roll back to the variable rate and get the market rate of the day. You can also choose to refix your interest rate for a further period. Depending on the bank, you can do this on their app, you can give them a call, or you can reach out to your broker to help arrange that to make sure you get that continued stability over time. The third option is to split your loan. If you're, say, 100% fixed at the moment, you've had some bonuses, some extra income, you want to help pay off that loan a bit quicker, you can split it and have a best of both worlds strategy. You can have half your loan fixed, have some stability, and half your loan is variable, as an example. Now, everyone's situation is a little bit different. Again, reach out to your broker and have a chat on what's going to make the most amount of sense. But in general, the banks are offering the better deals to newer customers, so don't be afraid to walk around and shop around using your broker to see what's going to work out best for you. But what happens if you had a change in financial circumstances? If you had an extra kid, you're not working at the moment, what can you do? Well, you can still try and renegotiate with your existing bank. That's where a broker can help out. We can contact your existing bank and see what they can do to give you a better rate and a better option. Sometimes you can even look at switching products between that bank. They might have put you on originally a basic home loan. Sometimes the banks won't renegotiate if you've got a basic home loan because it's just that. It's a kind of no frills product. But we've had cases recently where we've moved clients to a package product. They've actually received a much higher discount, which negates the fees that are going to be applicable per year. Keep in mind, different banks have different ways of assessing your situation. While some banks might not accept your Centrelink income, or if you're on maternity leave, other banks are completely fine with it. So hit us up. If you're in that situation, you're not sure what you're eligible for, we can do some numbers to see what's possible in your situation. How do you negotiate a lower interest rate with your existing bank? It's going to be pretty hard to negotiate a lower rate with your bank unless you know what's available. So I'd suggest having a look on their website. Usually they'll have some interest rates advertised online, which includes their new to bank offers that you can use as a bit of leverage when you're discussing with the bank. You could even call up the bank and pretend to be a new customer to see what they offer you before you tell them you're existing, obviously. Find out if there's anything that's going to stop you from negotiating with your existing bank. If you have less than 20% equity, so if you paid lender's mortgage insurance, or if you bought your home in the last 12 months, you're going to be less likely to be able to negotiate with your bank. They may not be willing to negotiate if you have an interest-only loan or certain types of investment loans. So keep that in mind when you're giving this a go. Third strategy you can use is trying to maximize your discounts. If you've changed your home loan type, so if, for example, you're living in the home and it's now an investment, find out if the interest rate is going to go up more than what you're currently paying. Or if, again, you're paying interest only on an investment property, it could be worth looking at going principal and interest if you work out the cash flow differences, because you're going to get a lower interest rate. Typically, the banks will want to keep you as a customer. So don't be afraid to use some of these techniques. Or as I mentioned earlier, as your broker, and for our existing customers, we typically help them with doing a home loan review and making sure the interest rate is as sharp and the discount is as good as possible. As a last resort, if the bank is not budging, they're saying, no way, happy to go, see you later, then you can try and actually put in a discharge request. So you can say to the bank, all right, I'm leaving, I'm going to go to ING, I'm going to go to Westpac, Bank West, and put in that form. And sometimes as a last resort, they'll say, no, Jayden, don't go, we don't want you to go. Here's the better rate. At the end of the day, it's worth a try to see what you can get, because extra money in your pocket is going to help with your cash flow and helping pay off that loan as fast as possible. If you don't feel comfortable with negotiating with your bank, that's completely fine. Hit us up. At Hunter Galloway, we're mortgage brokers. We help home buyers across Australia. There's no fees for our services, and we'd love to help out with either renegotiating or helping with refinancing your home loan. Check out our website at huntergalloway.com.au. Until next time, see you later.